Look, I'm going to be completely honest with you. Right now, while you're watching this video, there's a pretty good chance you're making the exact same mistake that cost the average investor 37% of their portfolio value in 2022. And I'm not talking about some obscure options trading strategy or crypto gambling. I'm talking about something way more dangerous. Believing that just because the market went up last year, it's going to keep going up this year. Goldman Sachs just dropped a research note that most people completely misread. They're not predicting a crash, they're doing something way more unsettling. They're showing you the math that makes a significant correction not just possible, but almost inevitable if certain conditions line up. And here's what pisses me off. Most finance YouTubers are either fear-mongering to get clicks or pretending everything's fine to look smart. Neither approach helps you actually protect your money. So, let's talk about what's really happening, because the scariest part isn't that markets might go down. Markets always go down eventually, that's not news. The scariest part is that you probably think you're prepared when you're absolutely not. Here's what I mean. Quick show of hands. How many of you checked your portfolio in the last week and felt pretty good because your numbers were green? Okay, now same question. How many of you could tell me right now, without looking, what percentage of your portfolio would survive if the S&P 500 dropped 25% tomorrow? See, that's the problem. We're all tracking the wrong number. Goldman's analysts aren't just throwing darts at a board. They're looking at something called the equity risk premium, which is basically the extra return you get for investing in stocks instead of just buying super safe Treasury bonds. Right now, that premium is sitting at around 2.1%. Now, you might be thinking, okay, so what? That's just a number. But here's where it gets interesting. Historically, when that premium drops below 2%, the market has corrected an average of 18% within the next 12 months. Not sometimes, not occasionally, almost every single time in the last 40 years. And we're already at 2.1%. We're literally one bad inflation report or one unexpected geopolitical event away from that threshold. But let's dig deeper, because this is where most people's understanding completely falls apart. You know what the real issue is? It's not that Goldman Sachs has a crystal ball. It's that most investors, and I'm probably talking about you right now, don't actually understand what they own. According to a 2023 FINRA study, 66% of investors couldn't correctly identify what factors actually move stock prices. Two-thirds of people putting their money in the market don't understand the basic mechanics of what they're betting on. That's like getting on a plane when you don't know if the pilot understands how wings work. Here's a real example. Let's say you've got $50,000 invested right now. Pretty standard retirement account, maybe some individual stocks, maybe some ETFs. You probably looked at your returns last year and thought, hey, I'm up 22%, I'm doing great. But did you stress test that portfolio? Did you run the numbers on what happens when your tech stocks drop 40% because interest rates spike another point? Because that's not a hypothetical. That literally happened in 2022, and it'll happen again. The psychology here is what really gets me. It's called recency bias, and it's destroying people's wealth in slow motion. Your brain is hardwired to assume that what happened recently will keep happening. Market went up, it'll keep going up. Made money last quarter, you'll make money next quarter. But here's the thing, the market doesn't care about your feelings or your assumptions. The market is a cold, ruthless math equation, and right now, that equation is showing some really uncomfortable numbers. Goldman's research points to 3 specific pressure points that could trigger a broader correction, and this is where you need to pay attention, because this isn't doom and gloom, this is just math. First, corporate earnings are stretched. The average PE ratio on the S&P 500 is sitting around 24 right now. The historical average? About 16. That means stocks are priced for absolute perfection. Every company needs to beat earnings, maintain growth, and keep investors happy. The minute one of those dominoes falls, you're looking at a repricing event. Second pressure point, commercial real estate. And I know what you're thinking, I don't own commercial real estate, why should I care? Because banks do. Regional banks are sitting on massive unrealized losses in their commercial real estate portfolios. We're talking hundreds of billions of dollars. When those losses get recognized, because they will, it creates a credit crunch. And when credit tightens, guess what happens to stock valuations? They drop. Fast. Third, and this is the one nobody wants to talk about, consumer debt is at an all-time high. Credit card balances just crossed $1.2 trillion. Student loans, auto loans, everything is maxed out. The average American is paying 24% APR on credit card debt while hoping their stock portfolio returns 10%. Do that math for me. You're paying 24% to borrow money to hopefully make 10%. That's not investing. That's gambling with borrowed chips. Now, you might be thinking, okay, this all sounds scary, but what am I actually supposed to do about it? And this is where most finance content completely fails you. They either tell you to sell everything and hide in cash, which is stupid, or they tell you to just keep buying because time in the market beats timing the market, which is also stupid if you're not actually prepared for what's coming. Here's what actually matters. The difference between investors who survive corrections and investors who panic sell at the bottom isn't their portfolio allocation, it's their psychology and their cash position. I'm going to give you a framework that Goldman's institutional clients use, but retail investors almost never hear about. It's called the liquidity ladder, and it's stupidly simple but incredibly powerful. You need 3 buckets. Bucket 1 is your emergency fund. Not invested, not in stocks, just sitting in a high-yield savings account earning 4 to 5% right now. This should be 6 months of expenses, minimum. Not 6 months of your current spending, 6 months of what you'd actually need if everything went wrong tomorrow. Most people have maybe 1 month saved. That's not a safety net, that's a suggestion. Bucket 2 is your opportunity fund. This is money that you're deliberately keeping out of the market right now, specifically so you can deploy it when, not if, stocks go on sale. If the market drops 20%, are you actually going to have cash available to buy the dip? Or are you going to be fully invested watching your portfolio bleed, unable to do anything about it? Because here's the brutal truth. The people who make generational wealth aren't the ones who perfectly time the market top. They're the ones who have cash ready when everyone else is forced to sell. Warren Buffett's sitting on $325 billion in cash right now. Not because he's scared, because he's patient. He knows something's going to break. He doesn't know when or where, but he's ready to move when it does. You should be too, at whatever scale makes sense for your situation. Bucket 3 is your long-term portfolio. This is money you absolutely do not touch regardless of what the market does. 20-year horizon minimum. This is where you can ride out the volatility because you've already secured buckets 1 and 2. See how different that feels? When you know your emergency fund is safe and you've got dry powder ready for opportunities, a market crash stops being terrifying and starts being interesting. But here's where people mess this up. They treat all their money the same. They see a number go up on their brokerage app and they feel rich. They see it go down and they feel poor. That's not investing. That's emotional gambling. Your emergency fund is not an investment. It's insurance. Your opportunity fund is not dead money. It's loaded ammunition. Your long-term portfolio is not your scorecard. It's your future. Different buckets, different purposes, different rules. Now, let's talk about what Goldman's actually saying in their report, because the headlines, as usual, are completely missing the point. They're not saying the market will definitely crash in 2026. They're saying that based on current valuations, current economic conditions, and historical patterns, the expected return for the S&P 500 over the next decade is around 3% annually. 3%. After inflation, that's basically zero real return for a decade. That's not a crash prediction, that's worse. It's a slow grind that punishes everyone who's expecting the same returns we saw in the 2010s. And most people's retirement plans are built on the assumption of 7 to 8% annual returns. Cut that in half, and suddenly your retirement date just moved back 10 years. Oops. The median investor sees these reports and does absolutely nothing. They keep auto-investing the same amount into the same funds, hoping everything works out. And look, dollar cost averaging is great, I'm not against it, but if you're blindly averaging into an overvalued market without any defensive positioning, you're not being disciplined, you're being passive. There's a difference. Here's a question I want you to actually think about. If the market dropped 30% next month, would you buy more, hold steady, or panic sell? Be honest, because your answer to that question tells you everything about whether you're actually prepared. Most people say they'd buy more. Data shows that most people sell. That gap between what we think we do and what we actually do is where wealth gets destroyed. The way you fix that isn't with more market research or fancier technical analysis. It's with a written plan that you create right now when you're calm that tells future you exactly what to do when things get chaotic. If the S&P drops 15%, I will invest X dollars from my opportunity fund into Y positions. If it drops 30%, I will do Z. No emotions, no CNBC panic, no checking your portfolio 16 times a day, just execution. Because here's what Goldman's research is really telling us. We're in the late stages of a cycle. Doesn't mean it ends tomorrow, doesn't mean you should sell everything. It means you should be playing defense while everyone else is still playing offense. It means prioritizing capital preservation over capital growth. It means getting liquid, getting clear on your plan, and getting honest about your risk tolerance.
You know what's wild? In 2021, I watched people with $30,000 portfolios acting like they were venture capitalists, throwing money at the riskiest possible assets because everything was going up. Those same people are now sitting on losses they still haven't recovered from. The market gave everyone a PhD in humility in 2022, and apparently most people already forgot the lesson. So here's what you're going to do after you finish this video. You're going to open a spreadsheet and you're going to calculate 3 numbers. 1, how much cash do I have available right now that's not invested? 2, if my portfolio drops 25% tomorrow, what would my total net worth be? 3, would that number fundamentally change my life plans or just make me uncomfortable? If the answer to number 3 is yes, you're overexposed, period. Then you're going to build your liquidity ladder. Move money into your emergency fund until it hits 6 months. Set aside your opportunity fund, even if it's just $1,000 to start. Whatever's left is your long-term portfolio, and that you can keep invested. But now you've got structure, you've got a plan. You're not just hoping the market keeps going up forever. Look, I'm not trying to scare you. Markets crash and recover. That's what they do. The S&P has survived 2 world wars, a Great Depression, multiple recessions, a global pandemic, and whatever else you want to throw at it. It's not going to zero. But you know what does go to zero? Your ability to retire on time if you make emotional decisions during a correction because you weren't prepared. Goldman Sachs isn't trying to predict the future. They're trying to show you the math so you can make better decisions. The crash isn't closer than you think because of some conspiracy or market manipulation. It's closer than you think because most people aren't even thinking about it at all. They're cruising along, assuming everything's fine until suddenly it's not. Be different. Be the investor who builds the liquidity ladder now, who stress tests their portfolio today, who knows exactly what they'll do when the market drops 20% because they've already written the plan. That's not fear, that's preparation. And in 2026 or 2027 or whenever the next correction comes, you're going to be really glad you did the boring work now instead of panicking later. The market doesn't reward hope, it rewards preparation. So get prepared.